It's now my pleasure to introduce our next general session speaker. The presentation is called Capital Planning, More Than Just an Adequacy Exercise. Our presenter is Gary Svec of Performance Trust. Gary is the Managing Director of Performance Trust's Investment Banking Group. He combines his financial institution background in accounting, taxes, regulatory compliance, and operations to be a leader in total balance sheet analysis. Gary has partnered with dozens of community banks in the last few years, helping them raise more than $500 million in capital. Gary's experience includes working with 3 community banks, and before that, he worked in public accounting, where he focused on community financial institutions. Please help me to welcome Gary Svec.
Thank you, Tom. Before I begin, I want to actually thank Tom and the BHCA. We have had a number of conferences get canceled. Our firm decided to go entirely virtual, even though we had one on the calendar. And I want to thank you for giving us the choice to be here today. Thank you very much, Tom. Really appreciate it. Okay, well, Tony made my job a little bit harder today. You know, when you try to be a comedian, it's always bad to follow a better comedian. So, Tony, thanks a lot. Really appreciate that. But I'm going to start today. Yesterday at lunch, during some of the sessions, we get inspired and we get scared. There's a lot of uncertainty ahead of us. There's a lot of things that we've never had to deal with before, ever. And so I thought I'd start with a little bit of levity. My adult daughters would call these dad jokes. So just bear with me a little bit. Where do fishes keep their money? In riverbanks. If money doesn't grow on trees, why do banks have branches? And my personal favorite on this list, what is the hardest part about being addicted to banking? The withdrawals. All right, the groans, that's the same ones that I get from my daughter, so let's just jump in. Okay, so this is an interesting slide. This is banks under $3 billion since January 1 of last year, the number of institutions that have raised subordinated debt. Look at the amount of transactions that have occurred. If you try to add up that list in your head, there's over 300 institutions that have raised subordinated debt since the beginning of last year. So I certainly don't want to focus on any individual transaction. I want to focus on this. Why? Why are financial institutions raising sub-debt now? If you look at the average capital ratio of most community banks, it's 50% or more higher than where it was in 2006, 2007, even early 2008. Before all the losses started impacting their capital, we operated with much less capital during the go-go days, 2006, 2007. We have far more diversification across our asset classes than we've ever had. In 2006, 2007, there was a huge concentration in construction and development lending. There were huge concentrations in mortgage lending. There were huge concentrations that pretty much are not allowed by our regulators anymore. Our earnings are strong. Our asset quality is strong. Now, we went through a massive credit event, covered over, of course, by PPP. So why are institutions now, with a lot more capital than we've had historically, with strong earnings, with clean asset quality, why are they raising sub-debt? And that's what we're going to, or capital in general, that's what we're going to focus on today. So here are the primary reasons that the banks that we talk to are raising capital. Number one, fixed peer comparisons. How many of us believe in the room that we are in a time of uncertainty? By the way, if it's a trick question, it's going to sound like this. This is a trick question. How many of us in the room believe we are in a time of uncertainty? For those of you not raising your hand, that's fantastic. I wish I was you. Now, the level of uncertainty is very, very different, right? Some of us believe there is great uncertainty ahead. Some of us believe there's a little uncertainty ahead. Some of us believe there's a medium amount of uncertainty ahead. But I think we can all argue that there's been a lot of change that we've all had to deal with, and we're in a time of great uncertainty. Is it more conservative to have more capital going into times of uncertainty or less? If you were a regulator and the I on your business card stood for insurance, and let's remember, the FDIC is an insurance company. They have one primary responsibility. What is that responsibility? To make sure that you do not make a claim against the insurance fund. That's it. I'm serious. That is their number one and sole responsibility. It's their job. We can hate them for it. We can be really frustrated on how they do their job, but that's their job. If they had to choose what your capital ratio should be, what do you think they would say? 100%. So the closer you are to 100%, the more they like you. The further you're away from 100%, the less they like you. And it's not about looking at you in a vacuum. It's at looking at you versus your peers. So a lot of us in this room, in fact, most community banks across the nation ran circles around our big bank counterparts with PPP. We have grown deposits like crazy. We brought in new customers. And the communities, there were ads in local community papers to say, local bank helps out small businesses. And it's been fantastic for our industry. The debt part of it is a little tough to swallow sometimes, but the program really helped community banks and helped small businesses. So as a result, banks have, for the first time in a very long time, they have outgrown their earnings. So some institutions are putting on some additional capital because their capital levels got lower than what they're used to. So they're doing that to fix some peer ratios. I'll go into some specifics in a moment. Second, in 2006, 2007, many financial institutions had senior debt loans. Covenants, collateral guarantees, some light, some heavy. And what happened in 2008 was very telling, which means when we needed it most, those lines either went into default or they got canceled before we were even able to draw upon them. When we needed it the most, it was debt, not capital. So some institutions are not saying, our phrase at Performance Trust is, hindsight is 20/20, only if you look. So a lot of institutions are saying, wow, where subdebt is pricing today and given the structure of subdebt, I'm going to pay off my senior line and get rid of covenants, collateral guarantees, and stabilize my holding company capital structure. We'll talk about that a little bit later as well. This is a big one. Outside of economic conditions that affect our industry going forward, and I think there's a lot of them, outside of that, we have a massive shareholder liquidity problem in our industry. And I know there are some of you in the audience right now that says, not me. That's great. I'm really happy for you. Most of the community banks I talk to have an aging shareholder base who has lived through the same 2 years that we have all lived through and seen all the uncertainty out there. You can't turn on a news channel, I don't care which news channel you talk to, without being scared out of your mind. It's all bad news. You turn on one news station, it's bad news one way. You turn on another news station, it's bad news the other way. And our shareholders are getting older, and they want to start reducing the risk in their portfolio. Many shareholders will say, I don't need you to sell the bank. I want the bank to be a stable part of the community. I don't need you to sell the bank. I would just like to get some cash to reduce the risk, to give it away to my grandkids, to buy the house I've always wanted, the car I've always wanted, travel or whatever they're going to use it for. I love the bank, but at this point in my life, I'd like to reduce the risk and get cash. How do we do that? I'm going to go through some specific numbers for you and show you. This is a big one. All else being the same, you should always take common stock over debt, all else being the same. But today, not even close for most or all of us in this room. We'll go through the specific numbers there. Cost of capital today. And then lastly, virtually everybody in this room has a massive non-accrual asset problem. It's called cash. By the time you are paying FDIC insurance premiums on all that deposit growth that you've experienced, if you're letting your money sit in Fed funds today, you are losing money every day. You are choosing to lose money. That's okay. You can choose to do that. But right now we have an issue that if we have more and more of our balance sheet go into a non-accrual asset, it's going to be tough for us to keep up with the cost of banking. We'll talk about that a little bit later as well. So we developed PT Score, which is a completely, it's using call report data. So it's a completely subjective process to evaluate risk. And it was actually started to help smaller banks deal with enterprise risk management. So it takes every component of your bank, liquidity, sensitivity in market, asset quality, earnings, capital, and puts them all into a calculator and then shows how they compare to each other, and we can tell you the risk profile of your institution. And when we think about issuing subdebt for an institution or helping them issue subdebt, we want to see what their PT score is, because many of our clients have become to look at that and say, this is a really good beginning tool for me to assess risk when I'm taking on debt of another bank. So if you're issuing subdebt, you need to know what your PT score is, at least from our perspective, because it'll tell you how confident you can be that you're going to get a good execution on your deal. If you're buying subdebt of other institutions, some market participants will say, easy choice. The bigger the bank, the lower the risk. Absolutely false. In fact, when you looked at bank failures, there were more big bank failures as a percentage than there were small bank failures as a percentage, because there's obviously less big banks than there were small banks. And some of the risk profiles of some of the big banks that the market absorbs because of liquidity have a very, very high risk profile. So this is a way to be able to look at risk without making a risk assessment based on size. So it takes all the different components of your PT score. And for us, when we are looking at subdebt of an institution, I want to know, what is your PT score? I can tell what their capital ratio is because they may be lower in capital versus their peers, so they have a higher capital score as a result. This is not looking at your bank in a vacuum. It's looking at your bank compared to all other banks that are out there, exactly the way the regulators do it. And it allows us to assess risk for that institution. We also can stress it, go back with historical loss ratios. There's a lot of additional data. We're not going to go into that today. But that's the first thing that we do for PT score. And for anybody in the room who is curious what your PT score is, all you need to do is to see me or to see my partners over here, Mike and Matt in the back. Just give us your business card. We'll send you your PT score. So you can start to see, hey, how does my bank compared to all the other banks that are out there under this one mechanism? So this is, again, a very interesting one that a lot of our banks are doing. One is to say, how are the regulators looking at my institution today, not based on me in a vacuum, but based on me compared to all the peers? In 2008, it was a very simple decision process for most regulators. How do I determine what banks I go to? The banks with the highest number of non-performing assets and the lowest amount of capital. Pretty straightforward. Everything else was an also-ran. And so you got listed by the regulators, and we have regulators that now work for us to say that's exactly how we did it. We went to the highest number of non-performing assets or biggest concentration in troubled asset classes with the lowest amount of capital, and we prioritized them. And if your bank was low enough on the list, maybe they left you alone long enough to solve your problem and get through it. If your name was high on the list, you were first in line. So a lot of institutions today are looking at this. So this is just a random institution that I chose. It's not in the Midwest. But this is an institution that has almost 9% capital. 9% capital. For many of us who have been in banking for decades, 9% capital seems like too much. You remember when 6 or 6.5 was good enough? Remember when, the regulatory minimum is 5. I've got 6.5% capital. I'm 30% higher than the regulatory minimum. That's fine to run my institution. That's a great return on equity. Until it wasn't. But this bank had 8.8% capital. And they were in the 27th percentile in their peer group. That means that 73% of the banks in their peer group that also experienced growth because of PPP and deposit growth and everything else that's impacting our industry had more capital than them. You okay with that? Is your regulator okay with that? Maybe so. Maybe you have an incredibly low-risk balance sheet, you have an incredibly strong history, and that's going to be fine. But if something changes, believe me, it will come into play. They also had concentrations. Many of us have concentrations. We are real estate lenders. We are ag lenders. We are mortgage lenders. And they had concentrations. So compared to their peer group, and it is remarkable, when I put the screen up on the slide, the bank said, yep, those are the ones that the regulators talk about, and they make sure to go in my exam report to say, just a reminder to you, as long as everything stays nice and hunky-dory, we'll let you continue to operate. The moment you stub your toe, I'm going to remind you that you over-concentrated a certain asset class. So this was just some data for the institution. They had an average asset yield of 360. Their cost of funds is next to nothing, like most of you. So if rates go down, that means margin compression, likely to happen. About a $500 million bank. Again, their peer group 50th percentile bank had almost 10% capital, puts them in the 27th percentile. So as of the latest call report, they would have needed $5 million to have 50th percentile peer capital. Not that that's a right or wrong decision. It's just a mathematical calculation. So we did a what if. What if they were to raise $13 million of sub-debt, keep some of the money at the holding company as an interest reserve, very important. They downstream $11 million to the bank, so not only could they get back up to peer ratios, but they have some room to grow. And this bank was growing. Unlike a lot of institutions around the country, this bank was experiencing a lot of growth. And let's assume the all-in rate on the sub-debt was 4%. It would be less than that for some institutions, but just for sake of argument. And this is where a lot of boards of directors just give me the full halt. Gary, my average asset yield is 360, and you're telling me to put on a liability at 4%. Are you out of your mind? How can I pay for that? My cost of funds. I'm paying my depositors 14 basis points, and you're asking me to put a liability on my books at 4%? I can't put assets on my books at 4%. And many institutions believe I'm going to have to lever that thing multiple times over to pay for it. Or it's going to have a negative impact on my shareholders if I were to do this. Maybe. Maybe not. So we ran through some numbers to say, if you put on $13 million of sub-debt, and you're paying 4% on that, and you were able to put on $15 million of new assets at an average yield of 3.5%, and you were able to then round that out, so $15.2 million of new assets minus $13 million of that liability coming in leaves $2.2 million left over, and I'm going to put on some additional liabilities at 50 basis points just to make everything equal out. If I were to do that transaction, I would be completely earnings neutral. Wait a second. If I put on $13 million of sub-debt at 4%, I only need to put on $15 million of assets to pay for it. That's the math. We'll talk about those assets in just a moment. So what would that do? Well, instead of being at 8.88% capital, I'd now be almost to 11% capital. That would give me some runway to grow and keep the regulators at bay. Hey, there's a lot of banks in my peer group that have less capital than me. Go after them. Not to say you should do it, just an option. This would give them room to grow their bank by almost $45 million, and that's not including any additional earnings retention, so it could be more than that. But this was just a what-if scenario. This is just simple math. This isn't a directive. This is just what if. So let's look at those numbers. So instead of being at 888, they would be now in the 72 percentile in their capital ratios if they were to do this. You can see the impact on their concentrations. Regulators like that. Your concentrations go down because you've added capital to the denominator. And this is a big one specifically for community banks. In this bank's case, their legal lending limit is going up by 25% by adding capital to the bank. And I will tell you, I've done dozens and dozens of these presentations to community banks all over the nation. This is a big one for small community banks. Most of us have a core group of clients that we would love to lend $100 million to if we could. You know, the gold-plated balance sheet. Those folks that have never missed a payment in their life, they've got tons of liquidity, they've got great properties, they're at low loan-to-values, high debt service coverage. You would love to lend them every dollar you possibly could, but they know that you could only lend them X because of your legal lending limit. When you raise capital and increase your capital ratios, it allows you to increase your legal lending limit. I was just at a bank about the size of this bank, and they said just on the participations that they sold off to other banks, so these are their customers. They spent all the time bringing those customers into the bank. They've wined and dined them. They are now core customers of the bank. They're at their legal lending limit, so they have to make them a loan and then sell that loan off to another bank that does nothing other than collect interest. They said just by being able to not have to do that, I could put on twice as many new loans to customers that I already have that I couldn't make these loans to before, and that would make this sub-debt raise incredibly accretive from day one. Really, really interesting. So we ran a scenario. What if, in this institution, they could just put $10 million of loans from having an increased legal lending limit at 4%? These were all conservative numbers. They believed the numbers could be bigger than that, and the rate would be bigger than that on the loans that they already made. What if they bought some sub-debt of other institutions? Hey, with cash at 6%, you know what? I really don't want to buy sub-debt of other banks. I got enough risk running my own bank. True. But when cash is at 6 basis points, when treasuries are at 50 basis points, Lunch speaker yesterday said, it may not be that rates are going up all that fast. If I can get a solid asset of a very solid institution that's not raising it because they need it, but they're raising it as a war chest of capital, and I can assess their risk in a very comprehensive way, kind of an interesting asset class. One of the few times in my career where I think it's really interesting to issue subdebt, and I can argument that it's really interesting to buy subdebt of other institutions. Really, really unique time. Normally, if you're doing a really good job issuing it, the person who's buying it is the one who's taking it in the shorts. This is one of those unique opportunities where it's really an interesting opportunity on both sides. So if they did that, we'll talk about green area assets, but there's an opportunity with fintech to actually utilize our balance sheets and reduce the risk of those fintech pools, but you got to be very, very careful on how they're structured. I want the fintech companies to retain the risk in the pool, and I'll let them utilize the liquidity on my balance sheet, and it allows me to keep the lights on. And then many banks are asset sensitive. We've been talking about this for a long time. I will remind you this. How many of us are, outside of mortgage bankers, don't raise your hand. How many of us are loving this yield curve? We love the fact that our loan yields go down every quarter. We love the fact that our investments are getting called away or mature, and we have to reinvest 100, 150, 200 basis points lower. We love to see our margin go down month after month after month. Remember this time. If rates ever go back up again, remember this time. You can do something about it when rates are higher. It's really hard to do something about it when we're here. Rates were a whole lot higher in 2019. Did you do something about it then? Did you project forward when everybody thought rates were going up and say, what if rates don't go up or go down? What kind of pressure is my bank going to feel? If your asset liability reports aren't pointing this out, you need to switch vendors. Because this was all knowable. I didn't know what was going to happen to rates, but I did know what would happen to interest margins if rates went here. And you need to model that. Remember this time. If we're in a different world where rates are at 3 and 4%, and you can lock in some assets that protect you if rates get back here again. If we turn into Japan, where they have a blip up in rates, and then they go right back down because the economy can't tolerate it. If we listened to that speaker yesterday at lunch from United Bankers Bank, if that's true, I don't know. But if it is, remember this time. And if you have the opportunity to do something about it, consider it strongly. So if they did this and they used some of the subdebt, or they paid for the subdebt that they would have to put on their books, they used some existing cash, and this bank has a ton of liquidity, more liquidity than they know what to do with. And I said this would mean $650,000 of after-tax income to you, and for them it would be 15% increase in EPS, at a time when EPS increases are really hard to get. This is not about do this. This is about, with all the hats that you wear, is it worth it to learn something new? Is it worth it to devote some time to say, I've got a problem? Are there solutions out there that I can do that I've never done before? Am I going to educate myself so that I am confident in my decision and I can explain it to a regulator or to my board, to my management team, that anybody coming in the door to say, there are things I can do right now. Is it worth me adding another hat to the 30 hats I have on already? In this bank's case, it was a big opportunity, obviously. So, as it pertains to capital, how much is the right amount? Anybody guess what the 50th percentile capital level is for all banks in the nation? That's from the biggest banks down to the very, very smallest banks. Anybody have a guess? Anybody shout it out? The average capital ratio of all banks in the nation is 9.94%. If you're a regulator, do you want your banks to be at average, above average, or below average? You want them at 100%. If the average bank in the nation is at 9.94%, and you're sitting with a 7 or an 8, or even a low 9, is that a conservative thing to do when you have the opportunity to fix it? Let's break it down. Banks 3 to 10 billion, a little bit lower, but still 9.25. For banks 3 to 10 billion in assets, the average capital ratio for banks 3 to 10 billion is 9.25. Pretty amazing. If you look at banks 1 to 3 billion, 300 million to a billion, or the 103 million, look at those average capital ratios. So if you are a regulator and they come into your bank and your number is below that number, do they have a right to say your capital is low? Yes. I'm an insurance company. I want your capital to be at 100. And all the other banks that have grown with PPP and all the other banks that have deposit growth, it's not a right or wrong decision. But as a regulator, these are the numbers that I look at. It's not analyzing you in a vacuum. It is how do you stack up versus everybody else. Now, does that mean that everybody else has too much capital? Probably. But as a regulator, who is one of my shareholders, let's make no mistake about it, a regulator is a stakeholder, just like a shareholder is a stakeholder. My regulator is going to look at these numbers. So, the amazing thing to me is, look at that. If you have 8% capital today, you're in the 10th percentile. 90% of the banks in the nation have more capital than you. That's astounding. Absolutely astounding. But you can fix it incredibly inexpensively for most of you, if you want to. So let's talk about the state of market. This is really interesting. Like other investment banking firms, we are data junkies. We get data on all publicly traded banks, and we slice it and dice it 6 ways to Sunday. And so here is some of the data. If you look at the average bank in the country, this was from maybe a week or so ago when I had to submit this. It's about the same today. The average bank in the nation trades at about 120 of book and about 11 times earnings. Now, if the range is very narrow, averages mean a lot. If the range is really wide, averages mean nothing. So let's break it down a little further. How about banks in the Midwest? The average banks in the Midwest trades a little bit below average on a price to book and a little bit below average on a price to earnings. Break it down further. How about all the different states in the Midwest region? So I just picked Minnesota for obvious reasons. Minnesota trades at a slightly higher premium to the rest of the group. And there is one state on the list that trades at a much bigger premium than the rest of the group, and that is South Dakota. Now, maybe it's because Kristi Noem is doing a great job. Maybe she is, maybe she isn't. That's an individual decision. But there's something else in this data. The average South Dakota publicly traded bank, there are only 4 of them, and the average asset size of that South Dakota publicly traded bank is over $5 billion in assets. Now, that's a precursor to my next slide. So we broke it down by asset size. Here is all publicly traded banks in the nation, under 500 million, 500 million to a billion to 3, 3 to 10, and over 10. Look at the average price to book of banks under 3 billion. What the heck is going on here? And then if you go up in size, look at the significant premiums for larger banks. That is a massive change. What's going on? Historically speaking, institutional investors like to invest in community banks for 2 primary reasons. One, we grow faster than bigger banks. If I'm a $500 million bank and I grow up by $100 million, that's 20% growth. As a shareholder, I love it, as long as it's safe growth, of course. If I'm a $5 billion bank and I grow by $100 million, that's 2% growth. Not that big a deal. It's just sheer dollar amount. Small banks have historically grown faster than big banks, just by the sheer dollars involved. Second, small banks historically have sold to big banks at a premium, and as an institutional investor, I like that payday. That has radically shifted in the last year. Institutional investors, there's exceptions to every one of these, of course. But institutional investors as a group have said, there's dark clouds on the horizon, and I don't think small banks are going to be able to compete for 3 primary reasons. One, this yield curve is likely not going to change, and our efficiency ratio is too high. If our margin continues to go down and our efficiency ratio stays high, there's going to be a point where we start to get really thin on operating income without credit losses. 2, small banks aren't likely going to be able to compete with fintech. They're going to continue to erode margins in business that they can put into a computer. So some of our core businesses are going to continue to be eroded away. 3, cost of technology is not going down. It's going to go up. And what you invest today at $1 million, 2 years from now, you're going to need to reinvest in something new to keep up with technology. And they're afraid small banks are not going to be able to keep up with the cost of technology. Pretty depressing stuff, right? Some of our most profitable clients are under $3 billion in assets. This is not true for many of you in the room, but it is true for a number of institutions across the country that are experiencing it now. And when PPP goes away, what does next year look like? I've seen some forecasts from 2021 to 2022 where earnings are down 20%, 30%, 40%, 50% when PPP goes away, when margins continue to erode unless rates go back up. Maybe rates will go back up. I hope they do. So this is really interesting. So if you're a small bank and you're trying to compete with a bigger bank that has a more high-priced currency, good luck trying to do an acquisition because their dollar isn't worth $1. Their dollar is worth $1.60 or $1.75 or $2. It's a very, very difficult environment. So what do we do about it? How can we use subdebt for acquisitions? Wait. You just said I can't do an acquisition because the big banks have a more expensive currency. What the heck are you talking about? Well, let's play again. This $500 million bank, that's a straw man for this presentation today. Let's assume that I came to them with this opportunity. So put yourself in the shoes of a $500 million bank, good performing bank, and I came to you with this opportunity. There's a $70 million institution that will fit you like a glove. They have a very similar balance sheet profile, very similar management style to you. You will be able to get very comfortable with this bank during diligence. They have a 1% ROA, low non-performing assets now and historically. The shareholders went out. They want 106 a book and 10 times earnings. How many of you in the room would be interested in learning more about this potential acquisition target? Nobody in the room would be interested in looking at a bank at 106 of earnings and 10 times. Okay, so for all the investment bankers in the room, you can leave now because none of these people want to buy anything. Of course we would. We're all going to want to see this deal, especially if you're a $500 million bank, and you can grow by something that you're going to get very comfortable with. So what's the catch? Well, there's going to be slight tangible book value dilution at close. I am paying a little bit of a premium, but there will be immediate 10% EPS accretion to my shareholders. That's pretty good. They want all cash, so I'm going to have to borrow. My holding company capital ratio is going to fall to 7.5, at least initially. There is very low opportunity for cost saves, but there's also very low deal costs in doing this deal. What if this deal is you? What if your best possible acquisition is acquiring a chunk of yourself? Let's go through the numbers. Assume this institution had 4 million shares outstanding and they're pricing today right around book value, which, by the way, banks under $500 million in assets, the average price to book of banks under $500 million in assets is below book value today, about 94 cents on the dollar today. You can go out and buy minority positions in a lot of well-run, profitable institutions below book value. Astounding to me. De novo banks are raising money at $130, $140 a book because they call it book value, but they're going to lose money for 3 or 4 years, and by the time they become profitable, your original $10 per share investment is now worth $8, right, or whatever the number is. You can buy established, profitable institutions below book value today. Just astounding to me. So let's assume that we give the institutional investors what they want. You want to sell out of the small bank. You don't care about the price. You want to invest in larger banks. We're going to let you do that. So let's assume that this institution had the opportunity to buy out 15% of their bank. So if they're a $500 million bank at 15%, that's a $70 million bank acquisition. A little bit of a trick there. And let's assume they funded it entirely with subordinated debt. So I'm going to bring in subdebt, and I'm going to start paying interest on that subdebt, and that cash is immediately going to go out the back door to cash out the shareholders. Your earnings are guaranteed to go down if you do this strategy. How many investment bankers do you invite to your table to say, I'm going to show you a strategy that's going to guarantee your earnings to go down? Want to talk about it? We're going to talk about it right now. Let's run the numbers. If this institution did this, and let's assume that they were going to make $4.5 million next year, and their earnings were going to grow by 5%. There's no guarantee of that, of course, but let's just run simple math. They will be paying interest on the subdebt, so their earnings will be lower than what they would have been had they not done this transaction. But their share count goes down dramatically more, and this will equate to more than 10% EPS accretion by satisfying the liquidity demand of the shareholders who want cash. Now, I had a publicly traded bank who found out that 7% of their shares were available from an institutional investor, and he's been trying to sell the block and nobody wanted it, and an activist investor was looking at buying that block. We were able to help them raise the sub-debt and buy out that block of shares to keep that activist away. Keep the fox out of the henhouse. Concentrate more ownership around the board table, around the management team, around the people that are still associated with the bank, and clean out those folks that want liquidity and are no longer associated with the bank. And I can do it in an incredibly accretive way. If my earnings do go up, that share count reduction is permanent, and therefore the impact on future earnings is even greater. And the shareholders who don't sell end up owning more of the bank without using any of their personal liquidity to get it. I reduce the denominator in number of shares outstanding, and therefore I own more of the bank. And the company is borrowing the money to pay back that loan to increase my ownership. Wow. This is phenomenally opportunistic. Now, what's the problem with this slide? What on here is a pure assumption which is guaranteed not to happen? It's in yellow, just to give you a tip. Is there any guarantee that our earnings are going to go up 5% next year? Or the year after that, or the year after that? Now, for many of you, you're saying, Gary, my earnings have been double-digit EPS growth. I feel very confident that my earnings are going to grow up. Fantastic. Hey, if we learned at the lunch thing yesterday, I was asking if anybody had a length of rope, right? But yesterday when we were listening to the talk, they said, hey, loan growth may be coming back to our industry. And so that earnings growth may be there. Maybe rates are going to go up, right? Maybe things are going to look good in the future. There could be another PPP program. I would doubt it, but there could be. So, maybe that 5% is not right. Maybe I want to show flat earnings. Maybe I want to show earnings going down a little bit and then growing from there. We can run different models, and we do. This is just an initial assumption. And I say, wow, that's pretty astounding to be able to do that. What would happen to this bank's capital levels? Again, I said their capital level will go from around 9 to about 7.5 initially, and then through earnings retention, of course, they could build their capital level back up. We have no problem reducing our capital level if we're doing an acquisition of another bank. We have no problem taking on sub-debt if we're doing an acquisition of another bank. But when we can buy ourselves significantly cheaper than another institution, is that something we should be considering? There's no risk of culture, clients leaving, key employees leaving. As Tony mentioned, the problems with the definitive agreement and whether it's going to be delayed, regulatory approval. We don't have to deal with any of that. Is it something we should consider? One of my favorite Warren Buffett quotes. There's a book of all the annual reports that Warren Buffett ever issued, going back to 1966. That's the year I was born. And there's a book of all of the annual reports. If you haven't read that book, it's a fantastic history on investing. It's just so incredibly humble, but such simple but brilliant ideas. It's a really, really good book. But this is one of my favorite quotes. So Warren Buffett was quoted at age 90 about a $1 million investment in Dairy Queen franchises. That's like you and I talking about the dollar we spent on a bottle of water. Right? He's a multi-billionaire, and he is focused here on a $1 million investment in Dairy Queen franchises. What happened is he and 3 of his billionaire buddies all put $1 million in, and they recognized Dairy Queen franchises were cash cows. And so they started to buy Dairy Queen franchises. And then at some point, they started to grow, and they had cash, and they had 2 choices. Either I could pay a dividend to everybody, or if somebody wants liquidity and the other ones don't, I might just buy them out. And so in yellow, Mr. Buffett said, repurchasing shares is something that helps us on our way to owning a larger percentage of our bank as we go along. They'd love to see us buy more banks, but if that's not available, they don't mind us intensifying interest in the one we already got. I love that quote. He's just so real. So normally I have directors that'll come up to me and say, we've been trying to do share repurchases forever. And normally I see a shareholder letter that sounds like this. We just had a record year. The future is so bright, we have to wear shades. We have the best management team, the best customers, the best communities, and our stock is going to go to infinity. If anybody would like to sell us back your shares, we'd be happy to buy it from you at book value. Right? How successful is that strategy? What if we actually talked about the realities of today? First and foremost, we want to thank you for supporting our institution. We're very aware of the volatility of the markets, the lack of liquidity in our shares, and the economic uncertainty that exists today. Things like the state of our political environment. There's a change in Washington, D.C., whether that's good or bad. There's going to be a change. The future of personal and corporate income tax races and capital gains, continuing impact of COVID and shutdowns and whether those are going to continue, global terrorism, the impact of a near-zero interest rate environment on our banks, and the impact of work from home. And this one, by the way, my goodness, holy cow. I've seen articles where it's going to take 20 years to absorb the commercial vacancies in some of the major cities and some of those commercial buildings with people working from home. How would you like to have a mom-and-pop coffee shop in the lobby of that building that is thinly capitalized and relies on that foot traffic to survive? So I live in Chicago. There's a major train hub in Chicago called Union Station, and when you walk out of Union Station, if you're heading north, there's a Starbucks on the corner right across the street from the Union Station. The busiest Starbucks I've ever seen. In fact, every morning when I would come in on the train, when I used to live in the suburbs, come in on the train, there would be a line of 30 people at the Starbucks, and they would go through that line in like 3 minutes. It was amazing how efficient they were and how much coffee they were serving. What do you think's going on there now? It closed. It doesn't exist. Now, Starbucks just moved that location to the suburb where the people are not going into the office every day because people are still going to get up and go to Starbucks. And instead of doing it across from Union Station, they're going to do it in their local neighborhood. And Starbucks is going to be perfectly fine. They're well capitalized. They've got locations everywhere. And they will sell you coffee wherever you want to buy it. But what if you were Gary Svec Coffee Company? And I just landed a high expensive lease across from a very, very high traffic train station. And I'm done. We haven't begun to feel what the impact of work from home is going to be long term. And PPP put a Band-Aid over it. You heard it yesterday at lunch, and there were a lot of really, really juicy points to say some of the smallest businesses are not going to be able to come back from this. We gave them money to support them for a period of time. When that money runs out, so will they. There's going to be a shift in the economy. Those shifts will create opportunities in some markets. Small-town America is exploding in growth for the first time in a century. People are realizing I can live in a better community with open space and better schools and leave my doors open at night, and I don't have to pay the rents or the lease rates to be in the big city. I can now live 3 hours away, and I can telecommute. I can do Zoom meetings, and I can telecommute. I don't have to do that anymore. Many, many people are saying, I'm never going back. What's the impact of that long term? There's going to be a massive shift. Hasn't yet even begun to feel. So again, it's not about saying the world is coming to an end. It is about talking about the realities. Is there anything on that page that is a lie? Anything at all? Is it just me, or are things starting to get a little wild here? This is such a powerful talk that I'm controlling the lights. This is amazing. Wow. Never had that happen before. That's awesome. Okay, so can a bank holding company really do this? This is all publicly available information, so you can pull it up yourself. Blackhawk Bancorp is about a $1.4 billion well-run, profitable institution in southern Wisconsin and northern Illinois. They announced a shareholder, a tender offer at $32 a share, which was 108 of book and 7.8 times earnings. $1.4 billion institution, really profitable, said, I'm willing to buy back your shares at 108 a buck and 7.8 times earnings. That's a stock I want to buy, not necessarily a stock I want to sell. I mean, that's a really, really strong institution. So when we started talking to them about this, their stock was at $27.50. They were 93 cents on the dollar, 8.5 times earnings. Their earnings went up as time passed. They announced the tender offer when their stock was at $30.75, which was 104 a book and 7.5 times earnings. They offered $32. They had institutional investors screaming at them saying, nobody's going to ever sell you shares. Not going to happen. You need to offer a lot more than that to be able to do a tender offer. They were oversubscribed. bought back almost 16% of their shares. Day after the tender offer, cleaned out all the shareholders who wanted to sell. Now, this is a short look back, right? This is 6 months. Next year, next month, tomorrow, their stock could drop. Who knows? I don't know. All I know for sure is, well, here's their earnings announcement. They did the tender offer halfway through the second quarter, and it impacted their earnings per share, just like I showed on the previous slide. My earnings per share are going up. We cannot control our share price. We can control 3 things: earnings, earnings per share, tangible book value. That's it. The market determines our share price. We cannot control that. We control earnings, earnings per share, tangible book value per share. And if we control those positively, historically speaking, the market rewards those who reward their shareholders. No guarantees going forward, but at least historically speaking. And oh, by the way, that was only halfway through the second quarter, their impact in the third quarter earnings. And again, it's public information. We repurchased our shares. We funded them with something that's really interesting. Now, here's something. Because mortgage rates are low, do housing prices go up or go down? Not a trick question. Mortgage rates go down, what happens to the value of houses? Are any of you in banking? Mortgage rates go down, what happens to the value of houses? Up. Now, if your borrowing rate goes down, what should happen to the price of your shares? But that's not what's going on. We can borrow at the all-time lows of rates in very stable financing, and we can buy the house we always wanted at near all-time lows. Wow. Now, if you do this, and your earnings just traject into the future down, you'll be like, now, if your earnings go down from here, you're probably not going to have access to the financing. Let's be real, right? If our earnings, go really bad for next year and the year after that and the year after that, our access to the debt markets is probably going to be gone. But if you're going to do an acquisition, do you have the same risk when you do an acquisition of another institution? Probably. Not to say you shouldn't do another acquisition. There are strategic acquisitions. There are things that help you grow or get into markets that you're not in or into business lines that you're not in. I am not saying don't do an acquisition. I'm saying if that's not on the table, there might be something that is on the table right now that can be really accretive to you and clear out shareholders who might be a problem. If enough of your shareholders want liquidity, they can force you to put a for sale sign in the front yard. We care about keeping you independent until you want to give up your independence. You can now do it under your terms instead of being in an environment where it's not under your terms anymore. I don't have the access to the borrowing anymore. I can't do it. Something to really consider. So we had another institution, similar institution, 4 million shares outstanding, their stock is trading near book value, and they wanted to raise some additional capital for growth. So they wanted to raise $10 million, and one of their directors said what almost always happens at most board meetings, which is, Gary, we don't like to take on debt at our holding company. What do you think I say to that? Remember, you're a bank, right? We're in the debt business. We borrow from our depositors every day. We lend to our customers. We lend to the people we invest in, right? We're a bank. But they said, listen, we're debt adverse. If we're going to raise capital, I never have to pay it back. I never have to pay a dividend. If things go to hell in a handbasket, my capital is there forever. And all those things are absolutely true. All else being the same, you should always have common stock versus debt. Debt eventually is going to come back, and I'm going to have to pay that back. And not all debt is the same. If you're growing the bank using a senior debt line with covenants, collateral, and/or guarantees, I think you're rolling the dice. Because when you need it most of all, it can be taken away from you, or it could start to tighten that noose around your neck if you stub your toe, if something bad happens in the industry, if something bad happens. There are forms of debt that are far safer, and there are other forms of debt that may be slightly less expensive but have a lot of strings attached to them. In times of great uncertainty, the older I get, if I can take that risk off the table and it just costs me a little bit more, I'm going to do that all the time, especially in this world where we're all experiencing things we've never experienced before. So they had the choice to either issue $10 million of subdebt or issue $10 million of additional shares. at $10 a share, they would have had to issue the shares at a little bit of a discount to where they were trading in order to get anybody to be interested. And most of this would have been a community offering. It wouldn't have been to institutional investors because they don't want to invest in small banks by and large, in general. So they said, hey, we're going to do a $10 million offering. I can do 1 million new shares, or I can put 3.5% sub-debt on my books. They assumed that their return on equity going forward was going to be 10% going forward. They were very confident. They're in a growth market. They had a niche. They believe that they're going to be able to experience that. So I said, let's run the numbers together. So here's the numbers on doing sub-debt. If I do sub-debt, there's my $10 million of sub-debt. That will add to my capital at the bank level, allow me to grow. There is my cost of the sub-debt, and my after-tax cost of the sub-debt was under 2.5%. For capital. Astounding. I mean, astounding. All-time lows. Or they could do new stock issuances. So you can see in the new stock issuances under projected earnings, the earnings, if you issue common stock, will be higher because I won't have the interest expense on the sub-debt. Very straightforward, right? But those new shareholders are entitled to their respective earnings per share, whether you pay it out in a dividend or whether you accrete it into tangible book value, they are entitled to that value creation. And so if you look at the cost of the new shares in this case, of course, or for a lot of really small bank, it's astoundingly high. And if they are able to achieve their 10% ROE every year, it's not going to be exactly 10%. It might be higher, it might be lower. It may be bumpy along the way. But if they're able to achieve that, look at how that cost of the common shares goes up as those shareholders get more and more earnings as your earnings continue to grow. This is a big number. All else being the same, I'd rather have common stock. Not even close for many of us. You could look at what the book value per share would be at the end of 10 years, but there's more. So they said, I get it, but at the end of 10 years, I got to pay back that sub-debt. If I issue stock at the end of 10 years, that capital is there for me to grow. And I said, you're exactly right. In fact, at the end of 10 years, I'd have $120 million of equity if I did sub-debt. I'd have $133 million of equity if I did common stock instead. My book value per share will be a little bit lower because there's more shares outstanding, but I kind of like the idea of having more shares. So I said, okay, let's just do a common denominator. Let's assume at the end of 10 years we decide to sell the bank for 15 times earnings. You can do any kind of common denominator. You need to have one at least. So in scenario number one, I'm going to sell the bank for 15 times earnings. I will get less money for the bank. I'll have to pay off the sub-debt, and my shareholders will net $166 million. In scenario number two, I'm going to get more money from my bank because my earnings are higher. I didn't have to pay that sub-debt cost. I don't have to pay off the sub-debt. My shareholders will get more money from my institution. So they're like, what am I missing? Of course, it's obvious to most of you sitting in the audience today. What you're missing is there's a lot more shares outstanding. So what's the per share cost? Well, if I issue sub-debt and sell the bank for a slightly lower value, pay off the sub-debt, I have a lot less shares outstanding. I earn $41 a share in a sale. If I do the new shares, not only did they buy in at 10 and now their shares are worth $36.44, but my shareholders who were up here now only get $36.44. The difference on a $10 million sub-debt is only $21.5 million to the existing shareholders. Now, you may say, it's still more valuable for me to issue new shares because those new shareholders are key employees, key people in the community, really important customers, and they're going to be a part of my growth going forward, and you could be absolutely right. This is not a right or a wrong decision. This is about running the numbers before you make the decision and making sure that it's not just somebody writing a check for $10 million that sits on the backside, because it's costing your existing shareholders $21.5 million 10 years from now if all those assumptions come true. Should you know that? We think you should. Now, what is my other option? Well, instead of selling the bank, what if I decided to say, you know what? I'm going to issue new shares 10 years from now, and I'm going to assume I have to issue those at book. So if I meet these earnings growth, instead of issuing 1 million shares today, if I fund it with sub-debt and issue shares at book value 10 years from now, I only have to issue 334,000 shares then. Much less dilutive. Again, if you're pondering this, call somebody. Say, can you help me think this through? Is there something I'm missing here? Impact and non-accrual assets. This is a big problem in our industry. I had let's just call it a $3 to $5 billion bank call me. They had $700 million in cash on their balance sheet, and it's going to go to $1 billion when all the PPP loans get forgiven in the third quarter, or were forgiven in the third quarter. They're now over $1 billion. And they basically said, I need to see every sub-debt offering you're doing. I need to put this cash to work. I can't survive earning 6 basis points on a third of my balance sheet. I ran a report of banks in the country with more than 20% cash on their balance sheet, earning nothing, 20% non-accrual assets. The list was several pages long. It's scary. Every day that you decide to keep money in Fed funds, you are deciding to lose money. It's true. Doesn't mean that you go out and go crazy and start investing the heck out of it, but it says, I am making a decision. It is not a conservative decision necessarily. If rates are here a year from now, you have guaranteed yourself to lose money versus what else you could have done. So let's just say, is it worth it to learn some new things? So I'm going to give one more favorite joke. What do the grandparents say to the grandchild? I want the groans. That's exactly what my daughters do. I love those. If you want more jokes, you can Google them, or I printed out a page of additional stupid dad jokes that you can say about banking. Come see me afterwards, and I'd be happy to give them to you, just for a little levity. So this institution, again, had 20% of their assets in cash and growing. As PPP gets forgiven, there's more cash that's being added to the bucket, more cash that's going to be a non-accrual asset. So much like many banks that we talk to, they're like, I have to learn things that I've never had to do before. I've never invested in sub-debt of other banks. I don't want to. I already have enough risk running my own bank. Why would I want to take on the risk of buying somebody else's sub-debt? Or remember those trust preferreds? Those were nasty. What happened with trust preferreds? And I want to address this. When you bought trust preferreds, you bought a pool. And in that pool were a bunch of trust preferreds that paid, a bunch of trust preferreds that deferred and then got back onto a pool, and then some that defaulted. So in every pool, you had losses. Sub-debt is you make each individual decision based on each individual bank. You create your own pool of only the lowest risk institutions. If you're curious about how to do that, raise your hand and just ask us about it. We'll show you some ways to help you get comfortable. There's no guarantee that we're not all going to struggle as we move into the future. But we can identify the banks that are likely at the end of the line. The ones that have run great banks, that have made it through every other cycle, and barring something catastrophic for our whole industry, they are likely going to continue to pay you back. These are banks that don't need the sub-debt. They're saying, hey, it's so incredibly inexpensive. It builds me a war chest of capital for whatever is in the future, whether that's shareholder liquidity, growth opportunities. If the market takes a downturn, I can buy branches, buy banks, FDIC acquisitions, whatever. It's a very, very cost-effective insurance policy. So all I want to do with this institution is to say, you're sitting on cash. You're used to lending the money out. That's what we do. We're lenders. That's what we know. But do we need to learn some new tricks? And I said, well, for you guys, if you could go from earning 6 basis points to 2% in that portfolio, which is not that hard to do, that's $2 million more. How many employees does that pay for? How much technology does that pay for? How many donations to my community does that pay for? Is it worth it to me to add another hat to my already growing list of hats that I wear? To quantify it. I am choosing to lose $2 million a year until rates go up. Now, you may invest in something and then rates go up and you have a $6 million loss. And you're like, see, I told you. I lost a little bit here, but I didn't incur that loss. You need to know what that's going to happen, but there's things you can do to do that. And what's happening to the rest of your bank in that scenario where that strategy might be bad? Should we know that? We think you should. So, capacity. Whoever tells you debt to equity level or double leverage ratio, if you are under $3 billion in assets as a holding company, the only regulatory restriction is if you go over 1-to-1 debt to equity, you have to ask the Fed for approval to pay dividends to shareholders. That's it. The other one is make sure that it's not causing an undue restriction on bank earnings to dividend up to pay the debt, but because the debt rates are so low, and for most of you, your earnings are really good, your debt service coverage level is really, really high. So you have a lot of capacity if you choose to use it. Share repurchases, again, For publicly traded banks, we much prefer a tender offer. You don't have SEC restrictions. It's a direct relationship between you and your shareholder. No brokerage account, no bid-ask spread. They deliver their shares. You give them the dollars. Very, very simple transaction, far more effective. The bank that I talked about earlier that did the tender offer had a share repurchase for 5 years and was very unsuccessful repurchasing their shares, thinly traded stock. Insurance and optionality. Again, if the insurance policy costs you 12%, I think you got a really, really good reason to say, no thanks, I don't need it. Most of you don't. I don't think you do. I don't think you need it. If I'm right, and you take on additional capital and you don't need it, the cost is this much. But if I'm wrong, and you don't take the capital and you need it, the cost is deadly. Something to consider when you're pondering these issues. I have 4 minutes left, or maybe I don't have 4 minutes. I went over. I'm sorry. I apologize. Any real quick questions? I will be here for the rest of the day. Yes, sir. Sub-debt can be classified either way. Most institutions put it in their investment portfolio because they contain a QSIP. Yeah, so the beauty of banking is that we are required to deliver financial statements every quarter. So you have core report data. And in the sub-debt document, there's some nuances to the sub-debt document. Some require, if your non-performing assets go over a certain level, they need to be notified. But you have access to that bank's call reports every quarter. That satisfies the requirement more than often. For our clients, they use PT Score to monitor the banks that they purchased sub-debt for so that they can see changes in their risk profile if something does change going forward. It's an obligation of the holding company, not the bank. That's how you get Tier 1 capital treatment at the bank level. It's debt at the holding company, Tier 1 treatment at the bank level.
How does the OCC and FDIC look at sub-debt as investment?
I can never speak for a regulator because it's really painful. It depends on what analysis you're doing when you buy the sub-debt. If you have a nice, thick investor presentation that lays out the risks and rewards of the institution, we've seen them say a blessing. Here's the only thing I can say for certain as it relates to a regulator. 2 years ago, you could have 10% of capital in loans to other banks. 2 years ago, they changed that to 25%. So the regulators increased the amount of debt of other financial institutions that you can own on your own books. So that's the only thing that I can say rock solid. I've had many regulators say, some sub-debt presentations are 2 pages, and they're like, that's not enough information to know this bank. Some sub-debt presentations are very detailed and have a lot of analysis, and they're saying, this lets you know that you did your job when you put on these sub-debt. It's hard to speak for a regulator in every situation because it's just too painful, and you're going to be wrong no matter what you say. But in general, they increase their limit themselves, and you should think about asset concentrations, capital levels, debt service coverage levels, risk profiles, those things should absolutely be considered, and I would recommend that you all do that if you're going to do that. But there are opportunities to buy banks like you that really don't need it. It's a war chest of capital, and it's kind of an interesting asset class given where everything else is. If I could buy anything at 3.5% or 4% levels, I probably wouldn't do that. But when I can't, necessity is the mother of change. And I encourage you all to consider it. I hope this was helpful. I am around. My team is back there. Please, if you want your PT score, give us your business card, and we'll send it to you. If you want your PT score, if you would like any of this analysis applied to your institution, your specific situation, just raise your hand or give us your business card. We'll be happy to do that for you. Thank you, everybody, for your time. Apologize I went over.
Thank you. Very good. Thank you.